Have you ever wondered about rate buy downs, loan points, mortgage points? How do you calculate them? What do they mean? Is it to your advantage? Well, today we're going to get into that, help you really get a good grasp on this topic. I've got Mike Anning with Mosaic Mortgage.
Hello, everyone.
And he's going to help us dig into that, give us some great visuals, so stay tuned. I'm Theresa Wellman. I'm sure you've joined our channel before, and today we've got some great loan information. So Mike's going to go ahead and share his screen and talk a lot about buy downs and points for a mortgage and explain how this all works. So Mike, take it over.
Yeah, excellent. Let me share my screen here really quickly, and I'm going to give a couple of bullet points just as we're laying this out. I'm going to talk just a quick history of what the rates have done over the last 12 months, and then how that impacts not only the interest rates that are being offered, but then the topic of the day is the question of points. So I'll definitely be able to provide some clarity on how all of that works. Okay, so on my screen here, what you'll see is a green and a red graph, and that graph, as you can see, slides to the right and down. So basically, what you're seeing here is a visual representation of the mortgage-backed securities market. This is the only thing that does impact interest rates. I hear experts all the time on the media and on the news saying the interest rates are affected by the 10-year Treasury, and while they are similar pools of money, the mortgage-backed securities market is exactly what affects interest rates. So the easiest way to explain it is that what you'll see here from the cost of interest rates, the money that we obtain to be able to lend out and borrow, or lend out for you to borrow, is basically dictated by supply and demand. So what we'll see on the chart here is that as it slides to the right and downward, that's a visual representation of money leaving the mortgage-backed securities market. So the money that we have available, the pool is getting smaller, which actually makes it more costly to borrow. Right. So what you'll see on the chart, you'll see days where it goes down, days where it goes up. And each one of those is a fluctuation of the interest rate sheets, interest rates that we get every single day. So good, green is good. Up is good, meaning that there's money coming into the market, creating a little bit more supply. The more supply, the cheaper it is to borrow. And as we can see, everybody knows that as of this year so far, we've seen a pretty significant increase of interest rates over the last year. So that's pretty clearly represented here with all the red that we've seen.
And it's also inverse, right? So as the line goes down, the rates
Costs
are going
go
up because
correct, right?
Okay.
Yeah, because again, it's just when we look at this here, it's just as it goes down, the money is leaving the market, so it is inverted. So down is bad, right? So it's not that the rates are going down; it's actually the costs are going up. Green is good, and you can see on the far right hand side of the chart, there's a pretty good green bar. As of last Friday, was one of the biggest favorable moves than we've seen in a long time.
Perfect. Okay, that's great. So can you tell us a little bit about what is a point? Why do we have points? You explained the costs here on this graph. So Can you get more into that?
Yeah, absolutely. So what you'll see here is a handful of bullet points. So the topic is what we call it, what's the point? Because it is something that's relevant. and over the last 10 years, we all know that interest rates were very low, even abnormally low. So most loans over the last 10 years had no points. There was an option to do no points. Points are not unusual. They're not strange. They've always been a part of the process, but because the supply of money has been just so abundant, there were a lot of options to not only do no point loans, but to actually get credits for some of those loans, right? So there would actually be like a points credit for your, towards your closing costs that people were able to take advantage of. With the interest rates increasing, and you'll see that a little later, is just the market's completely changed. So it's important to know that points. What is a point? The easiest thing is 1 point equals 1% of your loan amount. So if your loan amount is $1 million, 1 point is $10,000. That would be the fee if you were paying a point. If your loan amount was $500,000, that would be $5,000. So 1 point equals 1% of your loan amount. It's important to know that there are two main types of points. One is called origination. The other is called discount. The best way to think about that is origination points are fees that the lender is charging to put the loan together, to underwrite the loan, to approve it, create the legal documents that you'll sign so they can actually send the funds for your purchase or your refinance.
And that's what has gone up quite a bit recently, right?
Absolutely correct. So origination is like a mandatory point because that's just the cost to put the loan together. And that's what the lender's either charging or earning, either as, loan officer commission or company revenue for processing that loan.
Got it. And the reason I understand that rates or the points, the mandatory origination points have gone up is because there is some risk that lenders perceive of people not keeping that loan as long, maybe refinancing in the future, right?
Exactly. So there's almost a double whammy. Of course, we've seen interest rates just from the securities market changing and the rates increasing. But lenders, as they price a loan, there are, when a loan gets funded, essentially there's anywhere between 1 to 3 points or 1 to 3%, almost like real estate commission. It's like loan officer or company revenue that gets paid. So when the bank funds a loan, they pay the loan officer or their company a percentage, and anywhere from 1% to 3%, because they're expecting the loan to be in place for 7+ years, right? So if the loan is paid and the lender pays that commission, and then let's say interest rates drop 0.5%. Most people are going to refinance to try to take advantage of that savings. In that case, the lender would lose money because they paid a commission but won't have the mortgage or the loan in place collecting interest for long enough to actually make money and to be positive. So lenders are making the points mandatory these days because they're afraid of that payoff.
Makes sense. Okay.
Mm-hmm.
Yep.
So as we're looking at the first point, origination points, those are standard. Those are more mandatory in nature because it's required to put the loan together. There is also another one called a discount point. And discounts normally sound favorable. Who wouldn't like a discount on their money? But in this case, the discount's a little bit, it's a different wording. But basically a discount point is an elective that a borrower can choose. So it is an additional amount of money by points, either 1% or 0.5%, that they can pay in exchange for a reduced interest rate for the loan.
Yeah. So that's our buy down rate, if you will, right? Where they buy down, they pay points to buy down the rate to get a discount rate.
Right. Yeah. They pay more money for the discount so they can have a lower rate. Yeah. And on a 30-year, and on a 30-year loan, though, it's like if you can pay that upfront fee and have a lower interest rate, lower payment for the life of the loan, it does save you money. But it just depends on how long does it take you to break even, and then what's the total forecasted savings that you would have there.
Yeah. So I think that's the key, right? Is understanding that math. We're going to get into that a little bit.
Yep, absolutely. And again, points are important because they are part of the closing costs, right? So it's important as buyers are comparing the loans. It's always interesting to hear, a nice interest rate quote. And someone will tell you over the phone or in an email that this rate has a 1 point cost or a 0.5 point cost, but it's always important to look at the total visualization. Look at the total amount of the cash to close, because in your head you'll have, I have 20% down. You'll think plus closing costs, maybe you have 10,000 or 15,000 in your head just as a round number, and then not realizing, it's going to be another $6,000 or $8,000 or $10,000 on top of that. So in addition to getting the rate and point quote, you really want to see that expanded with total cash to close for the transaction.
Got it. Yes. Mm-hmm. To compare apples to apples is what you're saying, right?
Right. Yeah. And just not to be surprised, because, when you get your offer accepted, if you're buying a home, you want to make sure when it gets accepted that you're not shocked because you're like, I thought I had enough money, but now I need to come up with an extra 10 grand somewhere. Right.
Yes. Exactly.
Don't put it on your credit card. That's a way.
Yeah. So is there a limit to how much somebody can buy down the interest rate?
Yeah, normally the limit is 3 points. You can on occasion pay more, but there are once it becomes over 3 points, then it's almost like the lenders aren't allowed to charge so much, right? Because then it becomes illegal based on some loan compliance rules from 10 years ago. They want to make sure lenders aren't abusing clients by charging them too much. So they're normally up to 3% is typically the tolerance. There are ways to get over that. It's not sure that it really makes sense to do. But each one of those could be looked at definitely case by case.
Perfect. Okay.
Another thing, points have always been around, right? So I've been in doing loans 22 years now. Points were always standard. They were just kind of part of doing a loan, the cost of doing business. Again, with the interest rates decreasing and the markets changing 2009 to 2011. And since the recovery, from that recession, interest rates are abnormally low. So a no point loan was fairly common. Now it's starting to get back to almost what we would say the old days, 20 years ago. Mm-hmm. But points have always been around, and they're typically, in addition to just loan officer revenue and or company revenue or lowering, buying the rate down. Points can also be added to the loan as a standard based on risk factors of the loan in and of itself. So for example, if you have a no point option on a loan, if you have a less than perfect credit score, there may be points added onto that just because the credit score is low. If you're buying a condominium, like a condo with 20% down versus 25% down, there is an add or points cost simply because you're putting 20% down versus 25. Those are just risk factors, and those are becoming, of course, more compounded today because some loans are coming in out the door with the points cost anyway, and then you have to add to that as well. So that's why looking at total cash to close is important.
Got it. So basically, Now there's another variable that you're pointing out, and it can be the actual borrower's qualifications or the property they buy can add additional points on top of the two that you might think of.
Exactly. Yeah.
Okay.
And so that's definitely, it is, again, one of those things has to be really thoroughly vetted, case by case. So hopefully by the buyers or people, that are watching this video start to get an understanding of what's required on our side so they can really do their homework up front and not get surprised.
Perfect. Yep. Mm-hmm. All right. So what's a question maybe that people should be asking, but they don't?
Again, the biggest one that I would say is really looking at the total cash to close as they're looking at proposals. That's really, and I've said that a couple times because again, you can hear or see a certain rate presentation and points are, hearing it's going to cost you 1 point, but not seeing it all put together with the title and escrow fees, with everything else that's going to be involved, making sure that you're prepared for that bottom line number. Okay. And then other thing.
Oh, go ahead.
No, the last thing I would say is this one, as we start looking at these points, particularly with discount points, is looking at the return on investment. Right?
Okay. Yeah.
The way that we would look at that in this case, the bottom thing that I have here on the slide is it takes money to save money. We've all heard, it takes money to make money, right? While you're investing. In this case, if you've got the capital, if you have the money to be able to buy down the interest rate over the long term, it will provide a long-term net savings, but it's just how long is it going to take to break even? So what I can show on one of the next screens, we'll do a calculation because normally if you can recover your money or your return on investment is less than 36 months, it's kind of, it's highly recommended. If it takes longer than a certain period of time, then it's discouraged. So again, it's just knowing what those metrics are, and everybody can kind of compare for themselves for what they're comfortable with.
Yeah, perfect. So I love this because I tend to be more analytical, and I think a lot of my viewers are analytical. So we're getting to the numbers and actually decide, does those discount elective points, or do they make sense, and how much, right? So we'll do some math.
Right. So I'm going to share on the next screen here, and I'll pull it up right now, which is a point, what we call the grid. Right. Okay. So this grid exists for every lender across the country in some form. Today is November 14th. So the numbers and the rates may change over time, but the principles of the grid here are going to be the same. So this is really what most loan officers aren't going to show the general public. Okay. So people here today are actually going to be getting some information here. So what you'll see here is when in mortgage speak, lingo, par is basically what we would call an interest rate that we can offer with no points. Right. And that's measured against a benchmark of 100.00. That's our price. So what you'll see on the grid here, there is no par price, right? There is no 100. The best that we can see in the price column is 99.75, right? Okay. So in this case, this is based on a purchase price of $1 million today, $800,000 loan with a 780 FICO. The interest rate would be at 7.125%. And that would actually cost a quarter point because it's just a hair under 100. Right.
Got it. So that's $2,000 if I do the math right.
It's about 25. Yeah, $2,000. Correct.
Oh, it's right there. Yes. You said 800 and quarter point. But
so this is the dollar representation, and then this is what the principal and interest payment would be based on an $800,000 loan. Right. Now, all of these options are available to borrowers. Right. Someone, if they wanted a 5.5% rate, I could get that to them, but it's going to cost them 5 points. Sorry about that. That changed it over. Right. That would cost them 5 points, right? So again, it's possible. Would we recommend it? Probably not at that amount. You can see the cost there is $38,000.
Yeah, right? So that's a huge addition. Yeah,
it would be probably more beneficial to use that towards the down payment to get the payment lower than it would be to pay the bank money for a lower rate, right? Yeah. More than likely. But what I have here in the illustration is like, okay, well, if we go down almost 1 point, in this case, it's 7/8%. 6.625 would be available. Okay. That would cost a little under 1 point, $7,000. And then the monthly payment would reduce to $51.22. Right. Okay. And I'll show this on the next grid kind of side by side, how we're kind of looking at it. But going up to even, 2 points, 6.125, you can see that's a 1% rate reduction for an upfront fee of $17,000.
Yeah. Okay.
Right. But it sounds like, again, as we're looking at what's that?
I was going to say that's saving over $500 in month cash flow, right? Yeah.
Yeah, almost. So we'll see. So what I'm going to do is on the next screen, I'm going to show a rate grid calculator, just so we can see side by side what those options are. Because for every lender, it may be 1 point, 3/4 of a point, half a point for the different rate reductions. And the reason I wanted to show that first grid or the first screen that showed the market fluctuations, because not only do the rates change every day, but the rate buy down can also change every day. So one day, 1 point can get you down 0.5%. The next day, it might only get you down 0.25%. So the investment or your return on investment is much less efficient because it's going to take longer to recover your money. So on the next screen here, using this grid as a template, what I've used is kind of a side-by-side calculator. So this was just kind of an example up on the top half, but on the bottom, I built it to kind of to reflect what we were looking at on the previous screen. So an $800,000 loan, a 1/4 point cost, and an interest rate of 7.125 has a monthly payment of $53.90. Right? Okay. And looking at the grid again with 1 point cost, $8,000, the rate goes down 0.5%. That's a monthly payment of $51.22. That saves you $267. If we divide the cost by the monthly savings, it takes 30 months to break even. That's pretty good. A pretty short window of time, right? 2.5
less
years.
Than 3 years. Yeah.
You're in the black. You've recovered your initial investment, and then every month after that, you're saving $267.
Got it. So to make sense or to understand if points make sense, you really got to understand how long you might be in the property, right?
Correct. Right. And anybody, I think it's generally accepted 5 to 7 years would be the minimum that you would want to be in the property. So again, that's kind of what you'll see on the column on the right with the red, yellow, green is, if it's less than 3 years, then it's kind of, I wouldn't say anything's a no-brainer, but it's highly recommended. If it takes between 3 and 6 years, it's like, well, we want to make sure that we're into the property long enough and that the odds, that you're comfortable paying that expense. If it takes more than 7 years, then it's generally not recommended because I've seen just life happen, things change, jobs change, lots of things can happen.
Even a refinance, right?
Yeah, correct. If you can refinance in 4 years, then you've lost money on that arrangement. So normally that's kind of the metric that I'll use to make a recommendation on that. But you can see here, this is the same thing, 800,000, 2 points. Sounds like it's a lot more money, right? $17,000, right? As opposed to 8,000, but the interest rate goes down to 6.1, right?
Yeah.
The monthly payment goes down, like you said, $529 a month.
Yeah, it's a lot.
Right. The break even time is still about even at 32 months, but after this, the interest saving is double for the life of the loan. After 32 months, you've recovered your upfront investment, and then you're saving, $529 a month for the next 30 years on a 30-year note. Yeah.
So it's a lot.
Right. So it's important, the misconception is points are bad. You just have to understand them, right? Because a lot of people, especially if you have reference over the last 10 years, people go, oh, no points options are the best. Why would you ever pay fees? Just the market has changed. It's getting a little bit more normal, and points actually do make sense. And in this grid example, as of today, it would be recommended if you have the money to make that arrangement.
Yeah. Okay. Or that's a good thing to negotiate with the seller or ask for gift money from family because there's a huge payoff pretty quickly, right? Yeah,
absolutely. And that was the one question that people like, this can be paid for by the sellers, right? So this type of concession is or negotiated tool, buyers can ask for a credit towards their closing costs, to help pay for these, to help pay for points.
Yeah, perfect. Well, I think we've covered a lot. So it's not really about how many points you can pay. It's about what points make sense, right? To pay. Right. And points are 1% of your loan amount. So you've covered so much for us today, Mike. Thank you so much. Do you have any item of value that you'd be willing to share with our viewers that might help them moving forward?
Yes, absolutely. So the points calculator, the spreadsheet that I have built here, again, the top is set, is set as an example. The bottom section, we can provide that for your viewers, because it is important to kind of look side by side and just look at the math, right?
Perfect.
Well, we can definitely make that available for you.
Awesome. And I recommend that you watch next our video that Mike and I just did a few weeks ago about what are mortgage lenders and what's the difference between them, because that's also going to give you perspective of understanding rates and the grids and all those different pieces. So thanks so much for joining us today.
All right. Thanks, everybody.